Okay, hi everyone, and welcome to this Orbex Trader Education session. I'm James Harte. Thanks a lot for joining me today. And in this session, we're going to take a look at what is a classic and indeed one of the most widely used trading methods, which is, of course, breakout trading. Now, the beauty of breakout trading and why it's so popular is that it's incredibly simple to use, but also extremely powerful. And some of the world's biggest hedge funds have been known to employ breakout strategies. However, because of its simplicity, it's often misused by new traders who struggle to trade breakouts effectively. So in today's session, I'm going to walk through what breakout trading is. We're going to look at some specific setups and also talk about the traps and pitfalls to be aware of with breakout trading and how to protect yourselves against them and get the most out of this method of trading. So as ever, if you have any questions along the way, please just type them in the chat function and I'll try and stop periodically to go as we go along and answer them, and then we'll also make some time at the end for questions. Okay, so as always then, let's jump right in. So what is breakout trading? Breakout trading is simply where we're looking to capture an expansion in price as it moves beyond either a defined high point or a defined low point. So this is the basis of breakout trading. You can see now why I say it's an extremely simple method of trading. So typically, traders will identify a trading range based on a high and a low point, and then they're simply going to look to enter as price breaks out beyond that high or low. Now, one of the key elements to successful breakout trading then is in how you identify the range, because correctly identifying the range will put you at an advantage above other traders who are identifying the range incorrectly. So some of the classic ways then to identify ranges are simply based on identifying highs and lows over certain time periods. So you could identify the daily range based on the daily high or low if you were trading on the lower time frames, or you could identify the range over the last 20 days. So the last 20 trading days is roughly a month. So this will give you the month's range, and this would typically be used for traders who are trading either on the 4-hour or the daily charts. However, you don't necessarily need to base your ranges on time frames. This is just one way of identifying ranges. You can also look to identify ranges simply using classic support and resistance. So you will often find that the market at certain times forms these sort of block formations where price is trapped between a resistance and a support level, and this gives us a classic trading range. So for those of you who are familiar with support and resistance, or for those of you who are in our support and resistance session, you'll know what I'm talking about when I say about using support and resistance to identify these range zones. So here we've got a great example. You can see we have a classic range example here where price is trapped between these set of highs, which give us our resistance, and these set of lows, which give us our support. And you can see that we've had several touches either side. So this is a really well confirmed, well established range. So when we see price move into this sort of environment, we can then be on the lookout for a breakout trade opportunity, okay? Because we know that price isn't going to stay in this range forever, right? So it moves into this range for a short period, but at some point it's going to break out. And typically, the longer the range persists, the greater the breakout is likely to be. So whenever we identify this type of situation developing, as I say, we can then be alert for a breakout opportunity. And this is how a lot of breakout traders operate. They're simply scouring the markets each day, looking for a chart where price has moved into a range situation like this with clear highs and lows framing the price action. And then they simply go to identify their breakout trading opportunity. Now, of course, the issue is that we never know which way price is likely to break. So one option that we have is that we can either set orders either side. So we can set buy orders above our resistance level, anticipating that if price moves above that level, it's going to break out. or we can set sell orders below our support level, anticipating that if price breaks down below that level, it's likely to continue lower and to break down. Alternatively, we can simply monitor price action and look to enter a market order as price breaks out of the range. However, as always, and this is one of the things I always reiterate during these sessions when we're looking at different setups and indicators and strategies, we always be wanting to look for ways to improve our chances of success and to refine our entry points. So we should always be looking to get the most out of our approach to trading. And one of the first ways that we can improve the traditional breakout method is to look to trade with the trend. Okay, so this is another thing which I reiterate, and this is an old market adage, obviously, the trend is your friend. So essentially, we're looking to trade on side with the trend so that momentum is in our favor. So when we're trading this method, we want to identify an impulsive move initially, okay, followed by a consolidation. So the impulsive move is our trending move. This is where the market expands in one direction. And then the consolidation period is this period here where we get our range form. And then we're simply looking to trade in the direction of that initial trending move. So if the market was moving lower into our range, we'd be looking to set sell orders, anticipating that we get a breakdown in line with the trend. If the market was moving upward into this area, so if we got a bullish trend before we set up this little range, then we'd be looking to set buy orders to trade in line with the trend. So trading in this manner, as I say, keeps momentum on our side, and it gives us a far stronger chance of catching a proper move. So here you can see an example. You can see that price makes this rather explosive move initially. You can see that we've even got a really large gap here that forms. So we get our clear impulsive move to the upside. So we formed a clear bullish move. And then price moves into this area of consolidation where price fails to break out above these initial highs and instead is trapped in this range. So we've got our resistance to the top side here formed by these 3 or 4 peaks. And then we've got our support to the downside here formed by these 2 or 3 dips. So we've identified our bullish trend. We've seen price moving into this range. And so all we're looking to do is capture a bullish breakout. Okay, so in terms of how we actually enter the trade, we have 2 options. The first is we can take a more aggressive approach where we simply set an order to buy above the high of this range. So once we've identified our resistance levels, okay, so once we've drawn in our lines and we have our range mapped out, we can then either enter an order to buy maybe 5 pips above the high of the range, or we can use a more conservative approach, because the issue with the aggressive approach is that oftentimes with these ranges you will experience a false breakout. Okay, and we've talked about these in other sessions with other setups, but a false breakout is essentially where price breaks out above the range or below it if it was a bearish order. Price breaks out of the range but then reverses and comes back down inside the range. So if you're simply leaving a resting order in the market, anticipating that price is going to break out, you expose yourself to unnecessary risk here, because the boundaries of ranges can be volatile areas where there's a lot of order flow going on, and price will often pierce the range boundary only to reverse and sometimes trade all the way back down to the other side. And these false breakouts are the #1 reason why many new traders struggle with breakout trading, because they say, well, I identified the range, I put my order in, the market broke out but then reversed and stopped me out. So this is nonsense, breakout trading doesn't work. However, as I say, there is another approach that we can take, and this is where we wait to identify price action confirmation. So to add more weight to our bias, instead of simply leaving a resting order in the market, we want to wait for price action to confirm our bias, or at least to encourage it, to endorse it more. So when we're trading this approach, this means that we'll only enter breakout trades on a candle close beyond the range boundary. So in this instance, where we're looking to set a buy order, so where we're looking to buy the market and get long in line with this initial bullish trend that we talked about, we would only do so on a candle close that closes above the range top. Okay, so if you look here, you can see that we had an initial candle here, this red candle, this bearish candle, which broke out above the top of the range initially, but then reversed and closed back inside. So we wouldn't have got long there. However, what you can see with the next candle, this large green candle, is that price exploded higher and closed above the range. So this green candle is the first candle that closes above the range top. So we would go ahead and enter our long order there. We'd get long there, buying the market, and then you can see after that, price takes off to the top side. So in terms of how we set stops and targets, the traditional approach is to place our stop on the other side of the range. Okay, so if we enter our long order here, and just to clarify, waiting for price action confirmation by no means guarantees you a winning trade. Okay, so just be clear about that. Waiting for price action confirmation does not mean that you'll win every trade that you'll take, because obviously there will still be plenty of instances where price reverses. However, what it does do is give you a little more confirmation, and it will certainly help improve your win rate, because you will experience far less false breakouts than if you simply enter orders, leave resting orders either side of a range. Okay, so back to how we set stops and targets. So the traditional approach is to place our stop on the other side of the range. So where we get long here, we'd simply have our stop below the support. Okay, so if we were getting short, we'd put our stop above the top of the range because we'd be selling below the bottom, but we're buying here, so we put our stop below the low. Now, the typical target is to aim for at least 2 times our risk. Okay, and this is another thing, another point which I reiterate in a lot of these sessions, is that we always want to look to be banking at least 2 times our risk. Okay, so at a minimum, we should be looking to bank 2 times our risk, and possibly more if we can, if the market allows for it. Now, another method that we can use rather, in terms of how we approach the stop loss setting situation, is we can look to use structural levels where we use highs and lows to place our stop. So if we look here, if we enter long on this candle here, essentially what we'd look to do is place our stop behind the last low. So if we track the move up from the low, you can see we rise up to here, we come down, rise up to here, we come down, rise up to here, we come down, and then we get a pretty straight move up here. So the last low would be this area here. So if we're entering long at this point, we put our stop below the last low. And simply all we're looking to do there, all we're looking to achieve, is that the market is going to protect us if it rallies back to this point, retraces to this point rather. We're expecting that that area is going to act as an area of support, and the price is going to bounce there, and our stop will be protected. So this is another way that we can look to place our stop. And the good thing about this is that although it's obviously more aggressive because we've got a tighter stop, which means that if price reverses in the range, there's a higher likelihood of us being stopped out. The upside is that we've obviously got a far reduced risk. So in terms of the move that we need to see the market make, in order to make our 2 times risk, we obviously only need a much smaller move. So instead of looking for price to make 2 times the width of this whole range, if our stop is only here and our entry is here, then the market only needs to move up to around about here to achieve our 2 times risk. So again, this is a slightly more aggressive approach. However, it's a methodical approach, and it's based on solid strategy using structural points in the market. And again, it reduces our risk and means that we only need to see a much smaller move made. And then obviously, if we do hold for a bigger move, we can end up making far higher multiples of our risk. So for example, if we did hold the trade for 2 times the size of this range, we could end up with 8 to 10 times our risk. So this is another way that breakout traders capitalize on fast moving markets, because again, this whole trading approach is premised on capturing momentum. So there was momentum in the market during this phase. There was consolidation here and a loss of momentum, and then we're anticipating an expansion of momentum here. So we don't really want to see price coming anywhere near these lows, because the highest likelihood is that we're simply wrong and the trade is going to reverse. So if we're right, it makes sense that our stop should be here, because price should just take off like you can see it does in this example. So this is a textbook example of a breakout trade. Now, we can also use certain indicators to help us identify these range situations and breakout opportunities. And one of the best indicators for this is the Bollinger Band indicator. So you can see the indicator here, this sort of green bubble that's enveloping price. And Bollinger Bands are great for giving us a guide to the trend direction in the market, as well as the level of volatility. So for those of you, I don't know if you were in the session, but for those of you who can remember, this middle band is essentially a 20-period moving average. The upper band is 2 standard deviations above that average, and then the lower band is 2 standard deviations below that average. So when the bands are flat, this shows that the market has moved into a range situation. When the bands are pointing lower, it shows that price is trending lower. When the bands are pointing up, it shows that price is trending up. And then in terms of volatility, you can see that when the bands narrow, that means that volatility has contracted. And when the bands expand, so when they become wide, like you can see here, that means that volatility is picking up. So a lot of people, when they're trading breakouts with Bollinger Bands, simply look to trade price as it breaks through either the upper or lower Bollinger Band. However, this tends to be ineffective over time because price will so often break the Bollinger Band only to reverse back inside them. So just trading the Bollinger Bands as a standalone basis for breakout trading doesn't tend to work. What we should be doing to give us a much better chance of catching a proper move is to look to combine Bollinger Bands with our understanding of support and resistance. Okay, this will give us a much better chance of catching a proper move in the market. So essentially, with this method, we're looking to identify a range in price when the market is rotating between a high and a low point. And this will be clearly identified by the Bollinger Bands, which will be moving in a flat fashion. So as I pointed out here, when the bands turn flat, this means that the market is moving into a range band situation. You can see that is the case here. We've got these lows, we've got these highs, the bands have gone flat, the market is ranging. So we look for the Bollinger Bands to highlight a range bound period. And then what we want to identify is the support levels that tie in with the Bollinger Bands. And then we look for price to break through both the Bollinger Bands and the support and resistance levels to confirm a shift in momentum. So let's take a quick look at an example of that to make that a little clearer. Okay, here you go. So you can see at this point here, look at the red lines first. So we have a clear range situation. We've got our clear lows printed in here. We've got our clear highs printed in here. So we've got our resistance, we've got our lows. So this is our clear range bound situation. And you can see that price is also respecting the Bollinger Bands. We're simply bouncing off the Bollinger Bands. We've got a little bit of movement at this point here, but we're still well inside our range scenario. So what we're looking for is a point where price breaks both the Bollinger Bands and the support and resistance. So now you can see that instead of moving higher or lower, the bands are roughly turned flat for the majority of the time during this period, indicating the range bound situation and the lack of momentum. However, we can note 2 important instances. So one, price has broken down below of the range here, and it's also broken down below the low of the Bollinger Bands. Okay, so you can see that we've fallen out of the low of the Bollinger Bands, we've broken the low of the range, and so this confirms the expansion of momentum. So the confluence of these 2 elements confirms the bearish breakout. Now, we mentioned earlier the importance of waiting for a candle close beyond the range boundary to go ahead and initiate our trades. And here you can see a fantastic example of why that's important. Because although price has broken out above the Bollinger Bands here, although it's broken out above the top of the range, you can see that we failed to close above the range top. Instead, we reverse closed just under the range top, and then you can see we suffered a sharp reversal lower. So as I was talking about a few minutes ago, if we were simply leaving market orders above the high of this range top, we would have been triggered long here only for price to reverse sharply and stop us out. Whereas if we wait for a candle close, so if we wait for that price action confirmation, you can see that we would have in fact avoided that losing trade. Whereas to the downside here, you can see that when price breaks down below the low of the Bollinger Bands, when it breaks down below the low of the range, it also closes below. And then if we go ahead and get short there, you can see the next candle is an expansion, and then we continue to track lower after that. So it really is an important point to take away from this webinar, that when you're looking to trade breakouts, the most sensible thing to do is to wait for candle closes. So far, we've looked at how you can trade breakouts of static ranges, e.g. ranges which are defined by horizontal support and resistance, like we see here. And we've talked about how you can use indicators. But you can also trade breakouts of dynamic ranges, okay? So ranges that are defined by structures such as a channel. So again, you might remember from previous sessions that we've done on trend lines and channels, but these are essentially structures that form when price is moving between two identical trend lines that are giving us a diagonal support and resistance in the market. So to identify a channel, we simply first establish a trend line, and then we clone it to give ourselves the other side of the channel. So in this instance here, we've identified our bearish trend line along these two resistance points. We clone it, apply it to the bottom, and you can see that these support levels line up exactly. So we've got a really solid channel identified here, and you can see that price is simply tracking along, oscillating between the highs and lows of this channel. However, you can see that at this point here, we get a strong reversal and price breaks out above the channel. Now, channel breaks can be a fantastic way to catch a reversal in a trend. In the way that we enter trades on channel breaks is simply the same as how we enter breaks of typical ranges. So again, we're waiting for a candle close. So you can see at this point, price is starting to grind higher, and then here we break out above the channel top. So we go ahead and enter long on that candle close. Now, in terms of where we place our stops, again, we can either place our stops below the low of the channel, or we can simply use that structural approach that we talked about with the traditional breakout. So we go ahead and put it behind the last low. So look, we start at the low here, we track up, we trace back down, we track up, we trace back down, we break out. So we're long at this candle close, our stop is below that low, and you can see that although price retraces and actually breaks slightly back inside the channel, our stop is still protected by that low, and then price continues to break out properly. So this is another great example of how we can use breakouts to approach the market. And instead of using a typical high and low support and resistance range, we're using a dynamic range. So we've identified price trapped in a channel, and then we've simply captured the expansion as price breaks out above that channel and starts to change trend direction. Now, when it comes to trading channel breaks, one of the ways that we can increase our chances of success, again, is to use indicators in conjunction with the structure. So one of the indicators which we can use to spot when momentum is waning in the channel and when the market is vulnerable to reversal is the RSI indicator, the relative strength index. So if we look at this very same example again, but this time with the RSI indicator turned on, we can notice something very important. So look, you can see that price is grinding lower in this channel. And to begin with here, each time price makes a new low in this channel, the indicator is putting in a fresh low. So this shows us that bearish pressure is building, that sellers are firmly in control and driving price lower. However, from this point here, you can see that although price is continuing to plumb new lows, the indicator is starting to put in higher lows. So this tells us that bearish pressure is now waning and bullish pressure is starting to build. So even though price is continuing to drive lower, there are less sellers in the market, there's less bearish momentum, and the momentum is starting to change direction. So when we identify this divergence, this is what alerts us to the potential for a breakout opportunity. Okay, so we identify our channels first of all. That's step one in this process. We go through our charts, we find pairs or instruments rather, depending on which markets you're trading, that are forming these clear channel structures. We pull up our RSI indicator and then we wait to identify this divergence. And once we see this divergence occurring, we then know that there's a potential reversal opportunity. And so this is when we zoom in closer and look to establish our entry opportunity. So again, this is a fantastic way that you can look to monitor markets and highlight these reversal opportunities, these breakout opportunities, because divergence is a really great indicator of a potential reversal, and it's extremely useful when used in conjunction with dynamic ranges such as channels. So once we've identified that divergence, we know that we're looking to trade to the top side. Why? Because price is moving in a bearish channel. Okay, the divergence is bullish, so we're looking to trade to the top side. If price was trading in a bullish channel and we had bearish divergence, we then look to trade to the downside. So we're monitoring price, waiting for a breakout above that channel top, and then we go ahead and enter when we get our candle close. Okay, so you should be really familiar with this term now, divergence. We've looked at this in quite a few different sessions that we've talked about with indicators and patterns, and it really is one of the most effective ways that you can employ indicators, because the typical way of using the RSI indicator is simply to look to trade the extreme. So when price moves into the oversold territory, you look to trade to the top side, and when price moves, when the indicator moves into overbought territory, you look to trade to the downside. However, one of the more effective ways is to identify this divergence in the market, this subtle shift in momentum that alerts knowledgeable traders to the potential of a reversal. Now, channels aren't the only dynamic structures that we can trade. Okay, we can also trade breakouts of patterns, because chart patterns, again, are simply just identified using trend lines. And one of the best patterns that we can look to trade breakouts of are triangles. So triangles are a consolidation pattern that are formed by two converging trend lines, which again demonstrate a contraction of momentum in the market, and breakouts from these patterns can be extremely volatile. So you can see here a great example of a triangle. Okay, we've got our two converging trend lines meeting at this point. Price is respecting the upper and the lower boundaries, and you can see that we had this clear bullish trend initially in the market. Okay, so price just pushing higher, and then momentum stalls, we start to contract, the moves are getting shallower, and then at this point, bang, we break out. So these are a really great pattern that you can use to identify this contraction in momentum, because again, to reiterate, all we're looking to do with breakout trading is identify a period where momentum has contracted and then capitalize on the market as momentum expands and price breaks out. So again, the method that we use for trading these patterns is exactly the same as we use for all of our breakouts. We simply enter on a candle close, and we either put our stop on the other side of the pattern or we put it behind the last high or low. And then we're simply looking to target a minimum of 2 times our risk. And again, as I say, one of the great things about triangles is that they tend to precede very volatile moves in the market, very explosive initial moves. So there will always be instances where a trade you take is wrong and it reverses, but all we're looking to do is identify high probability setups and then refine our entry points and our entry methods to improve our chances of success. Now, another way of trading breakouts beyond trading the initial breakout itself is to look to trade retests of the breakout zone. So what you will often see, as you can see here, is that price will break out above a boundary or below a boundary. It will then reverse, retest that breakout zone before continuing. And this retest offers really great opportunity to traders. So let's take a look at a better example. Okay, so here you can see we have a really fantastic example. So we've got our resistance levels here marked in with our lower and upper resistance levels. So this is our resistance zone. Price breaks out above the top of that resistance. So we've broken out above the range high, and then we've traded back down, retested that zone, reversed and closed back above it. So this signals to us that the breakout is real. Okay, if price broke out above this range high, traded back down and broke back down inside, then we'd know we were likely looking at a false breakout. However, because price has broken out above that range, traded back to retest it and held, this suggests to us that the market is likely to continue higher. Okay, so this is the important point. This is basically the pivot zone. This is the deciding area where we know if price, where we have a good idea whether price is likely to continue the breakout or whether it's likely to fail. And so the hold of this retest suggests to us that buyers are indeed in control, okay? Because remember, all that's ever going on at any point in the market is a battle between buyers and sellers. So each time that price has tested this zone, sellers have been stronger than buyers and driven price lower. So at this point here, for price to break out, we know that there must have been stronger buying in the market than there was selling. Now at the point that price reverses here, we know that sellers have stepped back in again, slightly higher up. They've driven price back down, and so this is the deciding point. Are buyers going to be strong enough to continue that breakout and push price higher, or have sellers step back in again with enough force to drive price back down? So for more conservative traders who don't like to trade breakouts in a traditional manner, this is a fantastic way which you can look to enter the market in a breakout scenario, looking to trade that retest. Because as I say, this is a very common occurrence. This tends to happen a lot of times, probably more times than you see a straight breakout. You'll see a retest of a breakout zone before price then breaks out. Costa asks, would these strategies work on any time frame? Yeah, Costa, these are definitely applicable for any time frame. But as I say in all of these sessions, the higher you go, typically, the more weight these moves tend to have. If you're looking at breakouts on a 5-minute chart, just the noise alone on that time frame might make them less successful, certainly make the breakouts smaller. So if you tend to stick to the higher time frames, 4-hour daily, etc., you'll typically find that the breakouts have more weight and it's easier to take advantage of them, and certainly easier to plan your trades, to identify the levels and give yourself more time with them. So we've looked at how you can trade the breakout, we've looked at how you can trade the retest. Now another way that we can look to trade is trading the so in terms of how we go ahead and enter them, yeah, I've just skipped ahead there on a chart, confused myself, so apologies for that. Okay, so we've looked at how you can trade the breakout, we looked at how you can trade the retest of the breakout. Now this is essentially trading the breakout of the breakout. So I know that sounds confusing, but let me go ahead and explain. So we identify our breakout, okay? This is the move where we know that buyers have overwhelmed sellers, driven the market higher. We've reached this point. This is where sellers stepped back in again and drove price down. But at this point, buyers stepped back in and confirmed the breakout and took price higher. So once we've seen this dynamic happen, once we've seen this zone defended, we can pretty much have a good idea or a good sense, be confident rather, that price is then going to go ahead and break out. But we can wait for one last bit of confirmation, okay? So this is, again, for the more conservative traders of you, because I know that not all of you will have the same trading style and the same trading approach. Some of you will be happy to trade that initial breakout. In some of you, you probably won't even wait for the price action confirmation. You'll be happy just to set market orders. But we always have to be aware of the different way in which people trade. So we've identified this first breakout, we've identified the retest held, and then the final piece of the puzzle is, of course, price breaking out above this high, above the initial breakout zone. So if we were going to be truly conservative and really wait for that last piece of confirmation, we could wait for the breakout, wait for the retest, and then go ahead and enter as price breaks above that high. And then the great thing about using this method is that we have a natural structural point to place our stop behind. So we simply put our stop behind this level here because we know that this was strongly defended, okay? So this was a strongly defended level. So we put our stop behind this point. And again, the great thing about entering at this point here is that we've got momentum on our side again. So where we're entering at the retest, momentum isn't particularly on our side because we're getting in a defensive position. The market is moving lower and we're looking to get long here. Whereas if we wait for price to then break out above that initial high, we've got momentum back on our side, okay? We've seen the bullish move up, we've broken out above that high, we've made an initial high, we've retraced, it's been defended, buyers have stepped back in, and then price breaks out. So if we enter here, we've got momentum back on our side. And again, we've got that really nice natural structural point to put our stop behind. Someone just asked, where do I take profit? So again, at a minimum, you'd be looking to bank at least 2 times your risk. So if this is your risk, you'd be looking for at least 2 of your risk. Are they applicable to all sessions? So I assume you're asking, yeah, for breakouts, yeah, all sessions. I mean, typically, if you're looking at higher time frames like this, these aren't so much session based. So you'll see that this has formed over a number of weeks. So we've gone from August here to November. So this is quite a big range. But obviously, you will find ranges of different sizes. So if you were trading the half-an-hour charts or the 1 hour charts, then yeah, you would find smaller ranges. Okay, and then the final concept that we're going to look at is trading a breakout of a triangle pattern. Okay, because again, when we're looking at trading breakouts, it's important once you get used to the initial foundation elements, okay, so once you get the basic concepts down, it's important to start to look beyond those and to find other ways of approaching the market. So we talked about trading a traditional high and low range. We've looked at trading dynamic structures, and then what we've got here is basically a combination. So we've got our static resistance, okay? We've got our resistance level marked here, and then we've got our rising lows here. So this gives us a rising trend line, and then what that forms is a triangle pattern, an ascending triangle pattern, okay? So this is typically a bullish breakout pattern. So you'll either see this at the bottom of a trend as a trend changes course, or you'll see this drawing a trend as price moves into a resistance level. But these are fantastic patterns to look out for, and the bearish version is simply a descending triangle, okay, where you'd have a support level and then a descending trend line. And so again, all we're looking to do here is identify our breakout, look for our retest, and then look for our push on, okay? Now you can see that this time, this is a good example of, again, where trades won't always work, okay? So you will get breakouts that fail. The important point is about learning to manage your risk and clearly identify how you're going to trade. So if you traded the initial breakout, if you traded the retest, or if you tried to trade the breakout above it, you can see here the price actually reversed and traded back inside the range. So again, the only method which would have actually worked in this instance is waiting for that extra breakout. Okay, so we got our initial breakout, we got the retest, price tried to break out above that high, it didn't break that high, we traded back down inside the pattern, but then we got a deep reversal here, pushed strongly higher, and then again, if we waited to trade that breakout from the initial breakout high, we would have eventually caught the move that we were expecting. Okay, so I hope you all enjoyed that session and found it really useful. Breakout trading is something that I use a lot to approach the market, so it's something that I feel quite passionate about, and it was very enjoyable to discuss these different setups with you and give you some insight. So just before I jump off today, are there any questions that I can answer for anyone? Thanks a lot for the questions that you've asked so far. It always makes the sessions a lot more engaging for people when we get people asking questions, because I know that some of you will probably have questions that you want answered, but maybe you aren't feeling confident enough to ask. So I definitely encourage you all during these sessions to ask as many questions as you want, and I'm always happy to answer them. Okay, great. Well, I'm pleased that you all enjoyed that, and if there are no more questions, I'm going to wrap up the recording and I'll catch you all next time. Brilliant. Thanks a lot, everyone. Take care.